Hello there, investorholics and friends. Welcome to another ETF Spotlight review. Today we'll be focusing on a sustainable ETF, and this one is the VanEck Vectors MSCI Australia Sustainable Equity ETF. This ETF could be appropriate for investors seeking exposure to a diversified portfolio of companies in Australia that have a strong focus on environmental, social and governance issues. It could be good if you don't have the time to go through and do all the research on the individual companies yourself. Companies included in this ETF, ANZ Bank, Telstra, Transurban and Goodman Group, just to name a few. So stick around if like sustainable investing and that type of thing is of interest to you. I know that it's becoming more prominent these days, so that's why I thought I'd take a look at some of these type of ETFs throughout the market. So stick around and have a look at the GRNV, which is the VanEck Vectors MSCI Australia Sustainable Equity ETF. Hey there, investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. Okay, let's just get stuck into it here. So the investment objective, GRNV, gives investors access to a diversified portfolio of sustainable Australian companies selected on the basis of in-depth analysis by world-leading research agencies MSCI ESG Research. GRNV aims to provide investment returns before fees and all the other malarkey that tracks the performance of the index. You might be wanting some more information about the index or a description. So the MSCI Australia IMI Select SRI Screened Index aims to represent the performance of a diversified portfolio of Australian companies that have high environmental, social and governance performance, so ESG. Why would we bother looking at this? Australian equity portfolio incorporating investor values and beliefs. True to the label, the Australian Sustainable Equity ETF encompasses both value-based and environmental, social and governance investing. We see a focus on ethical standards through positive and negative screens, so screening for fossil fuels, human rights issues, controversies, issues, all the same thing, and socially responsible investing, so SRI, social responsible investing. That's probably something we should keep our eyes on these days. And that's combined with ESG leadership, so you want the company to have a good leadership. State-of-the-art ESG leadership approach, leveraging MSCI's leadership resources and its ESG data metrics. There's quite a lot of information available on the MSCI website. If that tickles your fancy, go and have a look at that as well. I think it's quite interesting, but that's just me. Okay, so at the time of my research, we had a net asset value of $26.78. It was trading above the net asset value at $26.98. We had a market cap of $71,300,000. If I can get my dyslexic brain working. Cost management here, so your management costs per year will be 0.35%, which is not too bad. Distribution frequency is quarterly, which is nice, so every January, April, July and October you get some money in your account to reinvest or to spend or do whatever you want with. Rough dividend yield is about 4%. So GRNV holds a total of 86 companies in its portfolio. Obviously excludes companies that own any fossil fuel reserves or derives revenue from mining, thermal coal, or oil or gas related activities. Excludes companies with business activities that are not socially responsible. And targets companies that have high ESG ratings, as we kind of touched on before. So we have a quick look back at that anyway. So percentage assets in the top 10 holdings. So the companies that make up the top 10 in the ETF, they equate to 42.09% of the portfolio when I completed the research. We had a price to earnings ratio, or PE ratio, for the last 12 months of 19.18. A little bit high, I suppose, but I suppose anything around 20 is not too bad these days. Price to book ratio, or PB ratio, for the last 2 months is 2.82, probably a little bit on the high side. So as I mentioned before, this ETF could be appropriate for investors seeking exposure to a diversified portfolio of companies that have a strong focus on ESG. And obviously you don't have to worry about the whole researching thing, just make sure you're happy with the companies that the ETF holds. So during the quarter ending the 25th of March 2021, GRNV's ESG score actually improved significantly from 8.5 to 9.8, and the overall ESG rating upgraded from AA to AAA. So pretty much what they're doing is they're filtering out more companies that don't have the high ESG standards. So that's kind of where they're at with that. So that's kind of an ongoing thing. Just one thing before we move on is just to have a look back at the price. So we're seeing the price trading at roughly 20 cents above the net asset value. So to me, it's not a buy. So you don't want to be buying a share in anything that's backed by assets. Obviously, you're overpaying for those assets because the net asset value of the fund is $26.78. You don't want to be paying 20 cents more by paying $26.98. So just something to keep an eye on. You really want to be buying when the share price is actually lower than the value of the assets that the ETF holds or the company holds. That's where we find our value in investing. Same as anything else, you want to be buying an asset for less than it's worth, whether it's a toaster or an ETF or a business or anything like that. Okay, let's have a look at the historical chart. So pretty much gained back all or more than it lost at the COVID crash, the end of early March last year. So recovered most of that. Before that, it was tracking quite nicely after the fall there at the end of 2008, early 2009. Overall, you're looking at a per annum performance since inception of 5.5%, or total return of 5.5%. I mean, if you had a bought down at the bottom of the crash there, you're looking at the 1 year performance, 33%, or just over 33%. So like a lot of things, if you had a bought down there, you've done pretty well in 12 months. You're looking at 30-40% on most stocks or whatever anyway. So if you'd bought then, you're doing reasonably well now. And as we all know, buying when other people are scared and selling is definitely the way to go. And that's the way that the majority of the wealthy people have built their wealth. When everybody else is running away scared, they're buying. Looking at the companies here, top 10 holdings, as we touched on at the start of the presentation: ANZ, Telstra, Transurban, Goodman, CSL, Fortescue, Newcrest, Sydney Airports, Brambles, and Xero. And then it tails off quite significantly, but you've got a total holdings here of 87 stocks. So the one thing that I like is the fact that people in the past, like a lot of things, there's no history. They think that things like sustainable investing is going to be bad for your returns, but research from academics, asset managers and index providers has shown a very strong link between good ESG performance and improving financial outcomes. And you know that's largely driven by reduction of risk. So these companies are highly screened, so they're taking out risks, like identifying companies that have a lot of risks in their business, and obviously only bringing the companies with less risk, and you know that's environmental, governance, and all that type of stuff into the ETF or personally into your own portfolio. So targeting high ESG performance can therefore pay you know, real dividends for investors, as I kind of touched on. Companies with strong ESG profiles typically enjoy enhanced corporate performance and financial returns, just perform better. So targeting these companies can enhance returns for investors, society, and the world in general. As I was touched on, we want to do some more research. You should always be doing your research, so get stuck into it. I think, you know, GRNV might not be a buy right now for me. I mean, I wouldn't be thinking about including it in my portfolio. I just don't think it's had enough time to run yet, and you know, I think it might actually be better to get some international exposure through a different ETF. So as we've kind of already reviewed, I think probably ESGI from VanEck Vectors is probably a better option than this one, but I think one to keep an eye on. Definitely these type of ETFs I think will overtake all the other broader base, less ESG type focus ETFs in the future. They'll gradually just die off, and you'll see these type of ETFs outperforming the rest of the market. Anyways, I hope that was valuable, and hopefully you enjoyed this quick presentation. Thank you. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.